What I thought I would do here is take about 5 minutes to give you a bit of an overview of what we're trying to do here before we get into the program for the day. And so these are the three things I just want to talk about in 5 minutes. The center, the economy, which is the Indian economy, and the forum, the Columbia-India Forum, which is what the day will be. So, the name of the center is Raj Center on Indian Economic Policies. I'm just stepping in now for Professor Panagaria, who you have here. And these are the two former directors of the center. Professor Panagaria is away for a couple of years now, and he asked me to basically step in on his behalf while he's away. And so this has given me an opportunity to also think about, what they have been trying to do here. We also have Mr. Raj here up front, who generously endowed the foundation, the center, about 2017, was it? Yes, so around 2017. So part of the thing we've been doing here in the first 4 to 6 weeks that I've been involved is thinking a little bit about what we are trying to do. And so for that, I looked at the name of the center, which is Center on the Indian Economic Policies. And so that's quite unique. There are almost no other countries, with the exception of China, that has a center on their economy. There's no, is there a Brazilian center for Brazilian economy? Or is there a center for, Indonesian economy? Not that I know of. And I think this is something extremely unique and very special. Also, as an economist, I think our tribe are often quite argumentative, quite difficult to deal with, but there is something also special about our tribe, which is that we think about the world in a way where our shared religion is, I would say, welfare and efficiency, and that allows us to talk about many different aspects of policy with the same language. And I think the fact that we have a center working on India, on economic policies, is extremely unique, and I wanted to basically advance that for the time I'm here. And so our goal of today and of the ensuing months and years is to understand and share and shape the story of the Indian economy through research and policy dialogue. That's what we are trying to do here. Now, on the economy, there's no reason to argue why we should care about the Indian economy, but I thought I will try my own version of it in one slide. And I prepared this actually yesterday, where we've been looking at, so one way to think about why India matters, there are many ways to think about it, but my favorite version of it is just looking at the history. Over time, so what this chart shows you is the share of the three very large economies today, India, US, and China, as a share of the world GDP, this PPP share. So, for much of recent history, let's say last 2,000 years, or even if you do this to the year 180 or year 1 CE, you're going to see that India and China made up roughly half of the global economy. So what has been happening in the last 200 years, in the very, very recent tiny past, is an exception. This is when the Western offshoots basically became dominant economic-wise, as you all know. That's kind of, you see that with the US displayed here, contributing to a third of the US economy, or the world economy. But now we have seen that in the last 2 decades for the rise of China, and now the next couple of decades is where we're going to see similar pattern for India. And I think the big question for all of us here is how we can all play a role, play a part in that story. How can we tell that story? And one thing you'll see in the program today, we have a lot of non-Indians, and a lot of topics are also not directly about India, but issues that affect India, because as India's share in the global economy grows, that relationship, India will drive the world, and the world will be more important for India. And so that relationship will matter a lot, and that's also what our idea for today's program is. And then lastly, on the forum, on the program, just reflecting that thinking, we have 4 topics for you all. The first topic will be on looking at the global economy 2025 and beyond. We have a keynote speech from the Indian Chief Economic Advisor, Ananta, who's just about to arrive, hopefully, and then on geoeconomic fragmentation. And this is kind of the farthest we are going from, let's say, core economic topics, but you still staying core to the economics, since, as we will see in his speech, these two issues are no longer so separate, geopolitics and economics. And then the last two sessions will be on India's digital revolution and on how AI will transform jobs. So let me just take that time and just stop here. I just have one last thing I wanted to show you. I wanted to leave with this slide on the welcome, where, if you know an Indian, and if you know an Indian economist, you know that you've been in many debates with them, sometimes unhappily, sometimes happily. And that's part of our tradition, but also the tradition of the Raj Center, which has seen over the years being part of this family, is of that discussion and debate. And it's very important for us, and we've done a lot of hard work over the last few weeks to ensure that we have people, not those people who are losing their hairs, but also the people who have very thick heads of hair. We want younger people to be involved. It is our duty to build that pipeline of the future thinkers, future shapers of the Indian story. So I want to encourage everyone here to please participate, please engage with us, because our goal is to shift our priors. The best gift we would want to give you is, at the end of the day, if you've changed your view on certain things, you updated your thinking and deepened your understanding and are inspired to do more about the Indian economic story. So let me stop here and move to our first panel. Thank you so much, and very warm welcome to all of you. Yeah. Okay, so let me with that just begin with our first panel. Our first panel is on the global economy, 2025 and beyond, and we have three very distinguished speakers. I'm just looking at the bios because there's so many things to say about them, but I'm going to just introduce the three of them. So first up, we will have David Mericle, who's up front there. David is the chief U.S. economist at Goldman Sachs. He's become quite famous in the last few years, even though those of us who know him for a long time knew that was coming. And one of the reasons why he's been part of many important conversations is many people are looking to David to understand where the US economy is headed, where interest rates paths are headed. He famously took a strong stance that the US can achieve with high likelihood a safe landing, and he continues to believe that, I believe. But this is really important for India as well and other emerging markets, because as we saw earlier, the US economy is a key engine of global growth. So we're going to talk a little bit about, David's going to talk about the US outlook and interest rate outlook, which matters for the world. He has too many degrees from Harvard. He has an undergraduate degree in economics and history, a master's in statistics, and a PhD in economics from Harvard. The second person we have is Tiago Severo, who's also actually a Harvard-trained economist, Harvard PhD. He's originally from Brazil. And Tiago he's currently a principal economist at BlueCrest. And so Tiago is one of the people that I know has thought very deeply about how emerging markets are evolving. Of course, there's some investors in the crowd, but what I find very special about Tiago's perspective is he is taking a serious macroeconomic perspective to how emerging markets are developing. So he's in the past has worked for the IMF, for Abu Dhabi Investment Authority, and also for Goldman Sachs. And then the last person we have is Devashish Mitra right there. Devashish is the professor and chair of the economics department at Syracuse, and he's also the professor of global affairs at the Maxwell School, which he told me has been forever ranked #1 in the US in US News ranking. He was very proud of that. So I thought I should share that with you. And then one of the things, he's going to be talking to us about something which a lot of us are thinking about, the trade outlook, and what the two different presidential candidates in the U.S. trade policies are and what that will mean for the world. So, and let me just say one more thing. I've really benefited from his thinking over the years on trade, on policy issues, and he's one of the best citizens in this community of Indian economics. So thank you so much for having it. So we can just, the way we're going to do this is each of them will take about 15 minutes or so to give their slides, and then we're going to have some Q&A and go from there, okay? So with that, let me start with having Tiago. Do you want to come up and the others can stay there because of the slides? It'd be better. Yeah, David starts, yeah. Great, thank you so much.
Well, why don't I get started while we wait for this to pop up. So as Ruchir said, the kind of big debate in the US and really the world over the last couple of years was back in 2022, could we solve this inflation problem that at the time seemed fairly scary without a recession? In early 2022, I think that was a fair question to ask. We probably had the tightest labor market in peacetime in the history of the United States. By some measures, inflation psychology was becoming a little bit unanchored. What economists call inflation expectations, at least in the short term, had drifted up pretty substantially. It was valid to wonder, could we renormalize inflation psychology? Could we rebalance the labor market in the US and all over the world without, in the process, having to impose a recession on the economy? My take is, by the end of last year, that debate, at least in a US context, was over. We had rebalanced the US labor market to pre-pandemic conditions. We had gotten inflation expectations back to levels that historically have been compatible with 2%. You can't have a persistent or sticky inflation problem without either an overheated economy or unanchored inflation expectations. So the big, genuinely interesting, genuinely difficult macroeconomic debate of the last 2 years, to my mind, had basically been concluded by the end of last year. I think on the economics team at Goldman Sachs, we were probably a little bit early in kind of calling an end to this, but over the course of this year, financial markets have substantially moved on. So, I would say that debate was basically concluded. The debate in recent months in the US has centered over the recent softening that we've seen in the US labor market. Just to give you a sense of where I'm coming from relative to where other people that you might hear from are coming from, we continue on my team to have a relatively optimistic view on growth in the US this year. We think GDP will grow around 2.5%. And we continue to see very low recession odds because I think the two big challenges of 2022 and 2023, the two things you were supposed to worry about, could we really solve this recession problem, this inflation problem without a recession? And then later in 2023, the regional bank mini crisis. Both of those problems had been definitively put to rest by the end of last year. At that point, we brought our recession probability down to the historical unconditional average of 15% for the next 12 months. There's a reason this isn't zero. The last time I probably would have said it was 15%, that there was nothing to worry about, was late 2019. It's a good reminder that random things can happen and you can get into trouble. But at this point, I would say the risk of recession in the US doesn't really look any higher than usual. Now, we've had another little kind of mini scare over the course of the summer because of the rise that we've seen in the unemployment rate. The unemployment rate rose from a historically extremely low 3.5% to a historically still very low 4.2% at the peak. Last month, it pulled back a little bit, but it remains the case that broadly, measures of how strong or how tight the US labor market is have been trending lower and have yet to stabilize. I think until they do stabilize, until that red line in the chart on the right, showing you the average of many measures of labor market strength, start going sideways, this is still something to keep an eye on. We've not been particularly worried about this, though, in a recession context, more in a context of failing to fulfill the Fed's maximum employment mandate, which since the Fed's last framework review in 2020, they've interpreted in a very aggressive way, I think appropriately so. One of the big ideas of that framework review was, look back at the last 3 business cycles. We've been able to have extremely tight labor markets by historical standards with all of the socioeconomic benefits they bring without having an inflation problem, there's no reason not to try to put everybody we possibly can to work. So we should aim to achieve that congressional mandate of maximum employment in a very aggressive way. I think it's fair to say that we have now slightly undershot where we were in 2019. The US labor market is a little bit softer. And so from the perspective of a policymaker, trying to do as well as they possibly can in achieving that mix of full employment or maximum employment and low inflation, maybe now there's a little bit more to be achieved. But I would not characterize this as much of a recession risk. After all, labor demand in the US is still very high. Job openings are still higher than they were before the pandemic. GDP is growing at about a 3% annualized rate. So it's kind of hard to imagine that employers would suddenly want fewer workers rather than more. And the dynamic that often characterizes the outset of a recession in the US, this vicious circle where I lose my job and my income, I have no money to spend at your business, now you have to lay someone off, and layoffs just spiral in a way that's very hard for policymakers to counteract in real time. We're about as far as we have ever been in history from having that problem. Very, very few people are getting fired. This has been the case for the last couple of years. Layoffs are extremely low. So what exactly happened over the course of the summer that got people a little bit worried in financial markets and policymaking circles that led the Fed to deliver a 50 basis point rate cut at its September meeting at a time when GDP is growing 3%, financial conditions broadly are very easy, circumstances that are normally not what you would see, not certainly the kind of economic emergency where the Fed has traditionally delivered large rate cuts. Well, my take on this would be labor demand in the US is healthy, the economy is growing at a good pace, but we suddenly had a fairly abrupt surge of labor supply coming above all from the immigration boom that we've seen over the last couple of years. Normally, immigration to the US is about 1 million people a year. Last year, it was about 3 million. At the peak, at the end of last year, it got up to about an annualized rate of roughly 4 million. So a level of labor demand that would have been very healthy for normal times, we think probably was not quite enough to prevent an increase in the unemployment rate. Those effects were probably amplified over the course of the summer when you also had the entry into the labor market of the usual youth summer labor force being out of school. Young people and recent immigrants seem to compete a little bit more over the common pool of jobs. And that's why this increase in unemployment that we've seen, again, from the mid-3s to a still very low 4s, has been concentrated, as the chart on the left shows you, not in people who have lost their jobs, but in new entrants to the labor force who haven't found a job, and has been concentrated, as the chart on the right shows you, among the foreign-born population and among kids. Very few kind of adult 20 or 25 plus native-born workers have become unemployed. So that would be my diagnosis. And as you can see in the chart on the right, or sorry, in the chart here, in the section of it on the right, immigration has come crashing down this year. That's probably not a coincidence. It's an election year. The White House perceives this to be a major vulnerability in the upcoming election. They seem to be doing what they can to get it under control. So I would say that the final scare of this whole inflation process, the uptick in the unemployment rate over the last year and a quarter, call it, to me also looks like something that's not really a recession risk. It's just that we suddenly had a lot of people enter the labor force, too many to absorb very quickly. Broadly, I think the US economy still looks like it's doing very well, although in a way that, while it has vastly outperformed consensus expectations, is not really as remarkable as it seems. All year long, we've gotten the kind of response to our economic forecasts, that sounds too good to be true. You guys have this wild-eyed, optimistic forecast. Surely, we're not going to quite do that well. And what I always emphasize is, no, actually quite the opposite. Yes, the US economy looks like it's on track to grow about 2.5% this year. That's about triple the consensus forecast from the start of the year. Most people expected sub 1% growth. But if the economy's pre-pandemic potential growth rate, the amount that you're supposed to grow every year, simply because productivity tends to rise from year to year and the working age population rises from year to year, if that was around a little less than 2% before the pandemic, we'll add a couple million extra people entering the country, maybe 1 million of them entering the labor force, and we really ought to be growing something like 2.5%. So I would characterize what we are currently achieving as nothing particularly remarkable, just potential growth. More people entering the country, we're creating jobs for most of them. That has meant that real or inflation-adjusted income has been growing at a good pace. That boosts consumer spending. We've also gotten a boost to consumer spending from booming asset markets. Household financial wealth is about as high as it's ever been in the history of the United States, and household balance sheets have only gotten stronger with stock market increases over the last year. You know, if those were the only two things that you knew, that people's real incomes were rising at a solid pace and that their wealth was the highest it's ever been and getting higher, you probably wouldn't find anything particularly remarkable about a strong consumer-led expansion, and that seems to be where we are at the moment. So to me, that means the activity side of the economy looks fine. Again, my take is that the inflation side of this puzzle was kind of dealt with a long time ago. By the end of last year, we could say that we had put in place the core ingredients to bring inflation back to the Fed's 2% target. We had rebalanced the labor market to pre-pandemic conditions. As I showed you earlier, we've now actually undershot the level of labor market tightness we had in 2019, and we had normalized inflation psychology. Now, a lot of people in financial markets have been much more nervous this year about inflation than we've been, and I think this was probably a key reason that Fed officials didn't start on their rate cuts until September. While the Fed leadership's views, I think, are very much aligned with ours, many Fed officials also shared some of that concern in financial markets. They said, hey, inflation's not quite 2.0 yet, and that's true. We're still at about 2.6%. You look at the labor market, and wage growth is still running at about 3.9%. We think it has to be about 3.5% in order to be compatible with 2% inflation. So for sure, we've come the vast majority of the way we need to come, but it is a valid objection. We're not quite there yet. Why has this not worried me? Because our diagnosis has been that what little is left of the inflation and wage growth overshoots relative to the Fed's 2% target simply reflects what we've characterized as lagged catch-up inflation. There are a variety of areas where costs rising a lot today does not mean that officially measured prices are going to rise tomorrow. One example of this, which has been kind of core to our forecast, and I think to the kind of sense that everything is going to work out in the end, that the Fed leadership has shared for the last couple of years, is that in the housing market, we saw early on, all the way back in 2022, that rents on units that were turning over on the market had cooled down a lot. From an explosive growth pace, shown by that dark blue line on the left, where rents rose 15, 20% on new units hitting the market, they had already cooled down to about 2% by end 2022. Well, it turns out the official data are measuring something a little bit different, not just units that are turning over, but also apartment rentals for people like me who are continuing tenants who, say, a website like Zillow, which provides a very timely indicator of rent growth, they don't know how quickly my rent is growing, but the government statistics do. Now, why does this matter? It had never mattered before, but it turned out that market rents rose so explosively that a lot of landlords were reluctant to pass along those full increases all at once because they thought people would be angry and move out. So the average American existing tenant wound up underpaying. And as a result, we've had to gradually catch up. Now, I think once you know that supply and demand are back in balance, once you know that market rates have cooled down, you know that eventually that catch-up inflation will come to an end and things will be fine. But it turns out there are actually a number of different areas of the inflation basket where the transmission lags can be fairly long. So housing is a very big component. Any area of the inflation basket that's regulated by the government, for example, car insurance, your costs rise today, you'd love to raise prices tomorrow, but you have to get regulatory approval and that slows things down. Or any area of the economy where contract durations are long lasting. Many hospitals have 2 to 3 year long contracts. Their costs, like nurses' wages, exploded in 2021. They would have loved to raise prices the next day, but if you're bound to honor a 2 or 3 year long contract, it can take a while to do that. In the labor market, labor unions are a good example of the same phenomena. Labor unions have on average 3 year long contracts. You can see from the dark blue line on the right, everybody else got to say back in 2022, the cost of living is up, the labor market is tight, give me a big raise or somebody else will. But again, if you're stuck on a multi-year contract, maybe you don't do the same thing for a couple of years. So it looks as though the inflation data are still elevated, but my diagnosis would be that that reflects and has reflected for some time simply these catch-up effects. That's good news, not bad news, because it means that the central bank's job of rebalancing supply and demand, of calming the underlying drivers of inflation, not only is done, but actually has been done for a very long time, which is why, despite inflation still being noticeably above 2, they feel at liberty to move on and get started with rate cuts. So I want to conclude by talking about 2 ways in which the US economy can have spillover effects that matter for India and for the rest of the world. One of those is monetary policy. You know, as I think is now well known in kind of academic research, US monetary policy tends to have an outsized impact on global financial conditions. So bit of a weird thing to talk about. What is the Fed going to do at an India-themed conference? But this turns out to have a lot of relevance. Our expectation at this point is that the Fed will cut interest rates at a pace of 25 basis points per meeting, although I would say I feel more strongly about that for the next 2 meetings in November and December this year than I do for the meetings next year. If everything goes fine for the next several months, if the labor market holds up, the unemployment rate doesn't rise, the economy continues to grow at a good pace, then I think it's possible that Fed officials will say, you know, we don't really need to do these rate cuts urgently to support the economy. Over the course of the summer and early fall, as the unemployment rate rose, suddenly the philosophy behind the rate cuts moved from pure normalization of monetary policy, that is, we went to a very high level of interest rates to fight an inflation problem. We don't have an inflation problem anymore, so we can bring interest rates down to a more normal level. It went from pure normalization to kind of normalization plus we need to support the labor market a little bit to make sure that the unemployment rate doesn't keep rising. If everything goes fine for the next several months, it's possible that we get back to pure normalization mode. And for that, I would draw an analogy with the last business cycle in the US, where the Fed was gradually raising interest rates. Why? Not because we had an inflation problem. Inflation was very low for the entirety of last cycle, but simply because it felt weird to keep monetary policy at an extreme setting once the original cause of going to that place was behind us. So we initially, last cycle, had double-digit unemployment. We brought the funds rate down to the 0 lower bound. Once we got back to full employment, that didn't really seem appropriate anymore. So they started hiking at the very moderate pace of 25 basis points every other meeting or per quarter. If we get back to kind of pure normalization mode, then maybe instead of this, a plausible alternative would be 25 basis points every other meeting rather than every meeting. But probably the key question for financial markets and for the Federal Reserve in its next monetary policy framework review, and perhaps the key question for global spillovers of monetary policy, is not so much how quickly do they move, but where do they stop? And I think this will be a big debate. We're writing down a terminal Fed funds rate of 3.25% to 3.5%. Now, if you remember last cycle, most people bought into this idea that the so-called neutral rate of interest had fallen dramatically and would forever be ultra low. In markets, in central banking circles, in academia, the conventional wisdom was that we would need 2 to 2.5% nominal interest rates, barely positive real interest rates, to stimulate enough demand in order to get to full employment. This had a huge impact on asset pricing, on the sense that government debt just didn't really matter anymore, on many, many different economic debates. We've been skeptical of that, as you might infer from the fact that we have the Fed stopping this time a full 100 basis points above where interest rates peaked last time. A couple of reasons for that. One reason for that, the main reason for that, this was really the gist of our argument last cycle, is the Fed funds rate is not the only thing that affects the strength of the economy. It was not surprising, we argued, that in the aftermath of a major financial crisis, the US economy, like every major economy that has experienced a financial crisis in history, experienced some long-lasting headwinds to demand. We had prolonged private sector deleveraging. We had disruptions to bank credit intermediation. We had fiscal austerity. But none of those things were literally permanent. And so we argued people had gone much too far in inferring that you would forever need near zero real interest rates to stimulate enough demand. Well, the market, 2 minutes? Yeah. The market has come around to that view. As you see in the dark blue line on the left, distant forward bond yields, as a very crude approximation of the economic concept of neutral, have moved up a lot. The Fed has shown an open mind. Their estimates of the neutral rate have moved from the mid-twos to the high twos. And I suspect that when Fed officials look at what markets think, when they look at what their own econometric models say, the impetus will be to continue pushing that a little bit higher, maybe into the low to mid threes. Second key point I would make is those post-financial crisis headwinds are gone, and at least for this cycle, we have a couple of very powerful tailwinds to demand that are separate from monetary policy. One of those is a fiscal stance that looks awfully strange by historical standards. In most of US history, when the economy was doing this well, when we were at full employment, we would have been running a small primary budget surplus. Instead, we have a large primary deficit. And that primary deficit, about 5% of GDP, wider than you would typically have had in a full employment economy, that boosts demand and to some degree offsets the depressive effect of higher rates. On top of that, we've had such resilient risk sentiment that while the Fed funds rate is much higher than it was last cycle, and in fact, interest rates across the Treasury curve are higher than they were last cycle, it is not actually true that broad financial conditions are tighter than they were last cycle. In fact, the opposite. Our financial conditions index, shown on the right, is actually meaningfully easier. Our financial conditions index is a summary statistic of what's happening broadly across financial markets, where we weight all of the different variables like equity prices, credit spreads, the trade-weighted dollar, long-term rates, short-term rates, based on how much they affect subsequent economic activity. The whole point of the financial conditions approach is that not a huge amount of economic activity is tied to the overnight interest rate. So the Fed funds rate matters to the degree that it transmits broadly through financial markets. If it's not transmitting commensurate with the normal historical transmission, then it's not affecting the economy in a commensurate way either. I wouldn't want to count on either of these things being true forever. I'm not saying we're going to have or be able to survive this level of interest rates forever, but for as long as we do have these two factors, you can probably keep the interest rates at a terminal level a little bit above that long-term neutral interest rate. And I think that's going to mean meaningfully higher interest rates in the US this cycle, with all of the resulting spillover effects to the rest of the world. Have a minute or? No, okay. I'm going to leave it there then. Thanks very much.
Thank you very much. Thank you, Ruchir, for the invitation. It's a pleasure to be here. I'll talk for the next 10 or 15 minutes about some of the key issues for the outlook for emerging markets. First, I'll talk briefly about recent developments in terms of EM growth and where the risks lay for the future. Then I will argue that the global economy, emerging markets in particular, and the global economy at large are likely to benefit from a significant disinflationary impulse in the years ahead. Third, I will discuss briefly some prospects for fiscal policy across emerging markets, and I will flag what I think are key risks to the outlook associated with the buildup of public indebtedness across EMs. And then I will conclude with a few brief remarks on what the opportunities and the challenges that these factors create for a large emerging market economy like India. So let me start with growth. I would say that perhaps one of the key distinguishing factors of the last several years has been the resilience of emerging market economies. Not only the EM complex as a whole withstand the pandemic shock very well, but also the recovery that we saw in the post-pandemic period was much sharper than most people had expected. So much so that we have seen EM growth momentum extending in recent years. And 2024 is shaping up as a year of decent growth again given that a number of important emerging market economies are doing well. And I could cite here India, of course, but I could also mention Brazil among the largest EMs in this context. Now, looking forward, most analysts, or the consensus view, is for EM economies to grow at a pretty healthy pace for the next several years. So when you look at the official projections by the IMF, and we'll be getting new projections shortly, but the latest projections that the IMF has suggest that EM countries should grow at around 4% a year until the end of this decade, right? And when you look at what investors are thinking, I would say that at least for the short term, asset prices are discounting an even more bullish economic outlook. So by my estimates, when you look at what is discounted in cyclical assets, for example, equities, exchange rate markets, credit default swaps, and local fixed income, so we see growth projections that are embedded into asset prices that would reach perhaps 5 or 5.5% for the EM complex as a whole, at least in the next 12 to 18 months. So much so that in financial markets, people have been following EM macro these days. They tend to say that EM assets are now priced for perfection, right? And here's where I think things get interesting, because my personal sense is that there are perhaps many more reasons for us to be concerned about the EM growth outlook rather than to be optimistic about the EM growth outlook. And I'll cite three factors that I think are important in this discussion. First and foremost, as you are all aware, of course, we have a key problem, which is the fact that the global economy's key growth engine, which is China, for the last few decades has been sputtering at this point, right? So in recent years, China used to respond for something like 30% of global growth and as much as 50% of EM growth. And that is perhaps probably underestimating the true contribution of China to the emerging market economies and to the global economy more generally, because it only accounts for the direct effects. You only look at like growth rates and then the shares of GDP and you calculate the contribution. But in reality, we all know that there are important spillover effects from China onto other emerging market economies. So China has been an important engine of growth, right? And it is well known that China is facing a number of headwinds, and most of these headwinds are structural in nature. And they range from things like very challenging, very adverse demographic profile in China, to the buildup of excess capacity in a number of sectors of the Chinese economy, to the overaccumulation of indebtedness and financial access in local and state governments and in a number of corporates. And so, I mean, there are problems here that will take a very long time for China to address. And perhaps what is more concerning of that is that the very resolution of these problems prevents the Chinese officials to rely on their true and tested strategy of pumping stimulus to move the economy uphill, right? And even in places where we have seen some stimulus being pumped, like, for example, monetary policy, credit policy, interest rates, the response of the economy has been pretty disappointing at this point. So to a large extent, at least insofar as monetary policy is related, it seems that the Chinese officials are pushing on a string. Right? So I would say we can summarize things as essentially assuming that China's growth model is exhausted now and that the global economy and emerging markets will need to find a replacement to that. The second key reason to be concerned about the EM growth outlook is related to the possibility of trade tariffs in the US and the likely escalation of responses by other countries that could result in a proper trade war. And I'm sure we're going to hear more about that today, but I think it is safe to say that if you throw sand in the wheels of global trade, very likely you are going to get a drag to global growth and a drag to EM growth in coming years coming from that, right? And I think it is important, I mean, to connect that discussion with the prospects for the US election that people will be talking about too as well. My personal sense, looking at the latest numbers, is that first, Donald Trump is poised to win the election next month. And second, he seems determined to rely on trade tariffs as a key mechanism of policy implementation in the United States, perhaps even much more so than what he did in his first administration. So I think this is potentially a serious threat to global growth and to the EM outlook. And then the third element that I think gives me concern is the fact that we have seen a substantial deterioration of fiscal fundamentals across the world, in the developed world, but also across emerging markets, that will require or may require potentially some degree of correction of fiscal imbalances in the future. And as a consequence, I think this could pose a headwind to EM growth in the years to come. But I'll talk a little bit more about fiscal issues in the third part of my presentation. Now, I don't have many slides, Ruchir. So if the outlook for EM growth is not particularly inspiring, I would say that there are more reasons for us to be optimistic about the prospects for EM inflation. Okay? So emerging market countries have experienced an acceleration of inflation throughout the pandemic and the post-pandemic years. We have started to see the initial signs of a reversion in this process. When you look at where consensus forecasts are, they suggest further convergence of inflation to pre-pandemic or even under pre-pandemic levels. Okay? But I think more importantly, in terms of like the fundamentals, the reasons to be optimistic are related to the fact that the global economy and emerging markets in particular are likely to experience a significant disinflationary impulse in the years ahead coming from the Chinese economy. When you look at China's manufacturing PPI, which is, now they're not moving. There you go. So when you look at China's manufacturing PPI, which is a pretty good leading indicator of global goods prices at the consumer level, we see that China's manufacturing PPI has now been in deflation for 26 consecutive months. Okay? And we have had an even longer stretch of deflation in China's PPI between late 2011 and mid-2016, so 57, almost a full five-year period, 57 consecutive months of deflation in China's manufacturing PPI. That was interrupted only temporarily around 2016-17 because the authorities deployed stimulatory measures. There was a rebound in commodity prices, and that led to a reacceleration in the PPI. But that process was temporary. If you look at the years shortly before the pandemic, the PPI had already drifted back into negative territory. And then the pandemic happened. We know all well what happened to global supply chains, disruptions to trade, this sharp acceleration in goods inflation. But that process is largely over. And now, as I said, we have been already experienced a pretty long period of disinflation in the manufacturing industries in China, which is providing a good impulse to goods disinflation around the world. So that is going to benefit emerging markets, no doubt, in the future. It is also important to keep in mind that China's disinflationary impulse is not restricted to goods prices at the consumer level, but the fact that we have significant weakness of demand in China and the need to reallocate capital in the Chinese economy and this buildup of excess capacity means that the demand for commodities is likely going to be subdued in China for the years ahead. So we will see, in principle, some degree of disinflation on commodity prices as well, particularly energy and industrial metals, which contributes to a disinflationary outlook for emerging markets. Large energy importers or large commodity imports like India would certainly benefit from that type of outlook. So I think there are reasons to be optimistic there. Now, obviously, the inflation story may move in the wrong directions. There are a few factors that could deviate things from this sort of like benign and sanguine view. I will cite two of these risks that I think are important. One I already mentioned, which is trade wars. I mean, in the event that we do see an escalation of trade tariffs, that would have first a direct impact on import costs for a number of countries that could create at least temporary inflationary pressures. Second, in the event that we do see an escalation of trade wars, very likely we would see also financial volatility and pressure on the exchange rates of a number of emerging markets, and that in and of itself would also create inflationary pressures in the near term in a number of countries. So I think those are two important elements. Another element that I think may create risks to the inflation outlook relates to the deterioration of fiscal fundamentals. If these trends end up resulting in fiscal pressures and financial volatility, we can eventually see that contaminating exchange rate markets. We can eventually see a contamination and unsettling of inflation expectations. And ultimately, depending on the magnitude of the fiscal problem, we may see an impairment of the workings of monetary policy across emerging markets, and that would make harder for local central banks to address any inflation problems. And that brings me to the third topic of my conversation, which is the issue of fiscal policy. Okay? It has taken way too long for fiscal balances to recover across emerging markets following the pandemic shock. Even though, as I mentioned at the beginning, the growth rebound has been very strong and the growth momentum has been solid, primary fiscal balances and overall fiscal balances have remained very negative across emerging markets in recent years. And despite the fact that the consensus view is for the EM world to grow at a healthy clip in the years ahead, the consensus view is also for emerging market governments to continue to run fairly large fiscal imbalances in the years ahead. And obviously, those fiscal imbalances, they accumulate and they generate a significant amount of public indebtedness and leverage in the public sectors of emerging market economies. Now, this is a fascinating topic. We could spend an entire day here talking about that, and I wouldn't be able to do justice to its importance. But in the last few minutes that I have, I hope I'll hammer on the message that we should be perhaps more aware of the risks that fiscal vulnerabilities pose. And I can tell you, based on my own experience, that investors, macro investors, are looking every day more carefully about these issues. This is not something that pertains only exclusively to emerging markets. Obviously, we have seen deterioration within the developed world, perhaps even at a bigger scale. But nonetheless, I think it is an important topic for emerging markets as well. So public indebtedness across the emerging world is now tracking at around 70% of GDP, and it is projected to grow to around 80% of GDP by the end of this decade. Okay? Just for reference, the IMF, which has spent a lot of time trying to assess what is the prudential level of public indebtedness that an emerging market could sustain, the IMF has concluded that that level would be around 70% of GDP. So we are essentially reaching that point, and we are projected to cross that threshold in the years ahead. I have done my own calculations in the past on the topic, looking at data for a panel of emerging markets. And what you can see is that, and the results, which is a parallel and a bit separate analysis from what the IMF typically does, but what you can see from the analysis that I have done is that essentially you reach a very similar conclusion. And the econometrics tells you that once public indebtedness in a typical emerging market exceeds 70 or 75% of GDP, the consequent increase in the interest bill that the governments face starts to accelerate above what the primary balances that the governments can generate in that context. So additional shocks to public indebtedness create this potentially these very adverse spiral dynamics in public indebtedness, where interest costs accelerate more than what the authorities can generate in terms of primary balances. Your debt stock builds up, and that feeds into higher risk premia, even higher interest costs, and creates a snowball effect. So, yes, I'm finished. So this is a very important issue. I don't want to claim that we are at the verge of a fiscal crisis in the emerging world. I think many people before me have talked about that thresholds, only to be proven that governments can lever up much more than what we thought. Also, when you compare the stance of emerging markets with developed markets, you see that emerging markets are in a better position in many respects in terms of their fiscal stance. But I do think it is important to keep in mind that this is an important risk, and perhaps more relevantly, historically, a number of emerging market debt crises have occurred even when public indebtedness levels were not particularly high. So high public debt is not a necessary condition for us to see emerging market debt crisis, and that's an important lesson from history to us. So let me conclude very, very briefly with a few remarks on what all these considerations mean for India. So first, India is the natural candidate to overtake China, to take the baton from China and becomes the world's engine of growth. It is a sufficiently large economy. It's starting from a sufficiently low level of initial income. It has a track record of strong growth. It has much more favorable demographic dynamics compared to its peers. So it's natural to think that India would be the candidate to replace China. Now, the external disinflationary impulses that I mentioned to you before would certainly help India in that task, particularly insofar as commodity prices are concerned, right? Now, it is important to keep in mind, though, that part of this disinflationary impulse is associated with the buildup of overcapacity in China's manufacturing export sector. And that means that India, or any other country for that matter, will have a hard time competing in global manufacturing. So if India wants to think about how to grow, it needs to consider a different growth model, right? Now, finding such a growth model is going to require a lot of effort. In particular, the Indian authorities will need to address the well-known shortcomings in things like education, healthcare, and infrastructure. Those are all expensive things. And so it's very important that the Indian authorities find the space in budgets to be able to redirect resources to make those investments. And with that, I will back Ruchir. Thank you.
All right, so thanks for the invitation, Ruchir, and it's always great to be back to my alma mater. I'm going to focus on the trade outlook, but I'll just mention briefly about the world economy. The world GDP is predicted to keep growing at over 3% next year, and here in the US, we had a strong jobs report. The stock market is doing well. Inflation is slowing, as David mentioned. And as he mentioned, as he explained, it's expected to do well, at least in the near future. Europe is also expected to invest in its infrastructure, as there are concerns about its competitiveness, as per the Draghi report. So in terms of world demand for goods and services, there'll be opportunities for countries like India. But India's export performance, as measured by its exports to GDP ratio, has been consistently worse than its competitor countries in East Asia and Latin America. And I'm going to talk about that a little bit. So if you look at India's export to GDP ratio in 2022, it was almost 2 percentage points lower than in 2013. And I'm going to get back to that, but just to give you these trends, it's India's been, so these are different groups of countries, with the high-income countries being eliminated. And India does worse than most of its competitor countries in terms of its export GDP ratio. So just something to keep in mind. I'm going to come back to that and switch to US trade policy during the next 4 years. At this point, if you're following the polls, if you're looking at things like Nate Silver's forecasts, or you're looking at the ABC 538.com, it's a margin of error presidential race. I actually disagree with Tiago on that, because I'm not seeing any data that actually has Trump constantly above Harris. So it's kind of a tied race at this point, which basically injects a lot more uncertainty, right? So the uncertainty at this point is important. But there's not much uncertainty about high tariffs. I don't think Harris is going to bring down the tariffs a lot. You're going to have a continuation of the tariffs that we see under the Biden administration, which is right now 18% on imports from China on average. And I'm going to talk about the Trump tariffs in a little bit. But the golden age of trade, which was 1950 to 2007, is over, at least for now, right? So if you look at the trade to GDP ratio, in 1937 it was 9%. this is the world trade to GDP ratio, went to 59% in 2007. Trade flows rose 30-folds between 1947 and 2007. We're not going to see that kind of trade growth in the near future, at least. So in case of Harris, the tariffs are going to be very targeted on imports from China, which are on average right now about 18%. Very limited tariffs will probably be imposed on imports from key partners, right? Including some countries in Asia and the EU, but tariffs will be very limited. The good thing is that she's been calling tariff a sales tax, which is something of significance, kind of indicating that it falls on consumers, right? So that's an encouraging thing because that kind of ties our hands to increase those tariffs in the future. Though in politics, there are reversals often. But there will be attempts to form partnerships with allies in terms of alternative supply chains, moving away from China. There's, for example, the Indo-Pacific Agreement, like in the current Biden administration. There's not much yet in terms of granting those countries market access in the US, but there is talk about creating these new supply chains there, moving away from China. So with Trump, you're going to see across-the-board tariffs, right? Up to 60% on China, up to 20% on others. And US allies will also face extreme uncertainty because he's going to, he's said that there could be even 100% on countries trying to move away from the dollar, right, as their global currency of choice. Trump's defenders will say, oh, he doesn't really mean it, but then they also say that, he says it as it is, so I don't know which one is true. Both can be true at the same time. So it's going to be the Trump's new tariffs will apply to more than 8 times more imports than his last round. So if you see the recent Peterson Institute working paper by Maury Obstfeld and Kim Klausing, it's going to be on 3.1 trillion worth of imports. So that's kind of will have catastrophic effects on the world trading system. And Martin Wolf, in a recent piece, has said that, if you compare with what he's proposing now, his first term trade policy was relatively modest. He calls it starter protection, right? So cooperation with allies on supply chains are unlikely because those slapped with high tariffs are unlikely to cooperate, right? And then there are going to be visa restrictions, including on H-1B and other kinds of work visas. So that basically will really have adverse consequences on service imports. So if India is looking to export like IT-related services, that's going to basically will suffer as a result of this. So there could be there's the possibility of an even bigger trade war with China. Bigger tariffs get bigger responses. Last time he started a trade war with China, China retaliated with tariffs on agricultural products, and those including on food grains, pork, and things, highly concentrated in products produced in areas where there's a high concentration of Trump voters. Republican vote share actually fell in areas more exposed to Chinese retaliatory tariffs. As there's a paper by Blanchard et al. In 2024 where they show that. And but the regions which were more exposed to import tariffs, that benefited from import tariffs, they actually it was found that in 2020 they were more likely to vote for Trump. And there's a paper by Otterdon and Hansen and one more co-author whose name I forget, 2024. But overall, there is a rise in protectionism. that goes along with populism. It's a key component of populism. And there is basically, in terms of protectionism, there is a race to the bottom between both parties. So it's not like, so if one platform kind of promises high tariffs, the other party also responds, and there's no way of kind of going towards freer trade. But I would say that, if you look at history, both economics and politics can provide a check on trade wars, right? So if you look at lessons from the 1930s trade war, right? What happened was there was a recession, and then in order to, as a reaction to that, they wanted to kind of divert demand to domestic products, and there was basically an increase in tariffs, which kind of through log rolling, which means that one senator says let's have a tariff on goods produced in my state, and then but you need to cooperate with other senators, and they basically there's a package deal, and it kind of escalates, right? So, but then other countries responded, and there was this back and forth. But in the end, what happened was it affected growth, right? Because you try to increase your demand through tariffs, but the other country imposes a tariff in return. That actually negatively affects demand for your own products. So in the end, everyone was hurt. And then they had the Reciprocal Trade Agreements Act of 1934, which was a bilateral agreement on tariff reductions. And so that kind of empowered export lobbies everywhere in the world, everywhere in the country to actually get organized, because basically they knew that if they push for tariff reductions here, they're also going to get tariff reductions elsewhere and get bigger markets. So, so this is basically, we can learn from history, and I think basically history of trade tells us that protectionism doesn't really last forever. There are going to be growth consequences. There are going to be political consequences as well when there are retaliatory tariffs from other countries. So we have to be a little patient. Maybe after 4 years, we'll see. I'm actually optimistic that this kind of protectionism and this situation of trade war won't last forever. So the question is, can India benefit from US's international economic relations with China, right? So if there is targeted protection on from Chinese products, then of course there will be more opportunities for India. But otherwise, even otherwise, if it's 60% versus 20%, still there is a differential there. So the question is whether India is able to grab these opportunities. And it's, India's had a number of opportunities, and I'm going to be more pessimistic than Tiago on this. And India consistently fails to grab opportunities, right? Of course, as I mentioned earlier, work visa restrictions by Trump will be bad for India's service exports. Even if he doesn't change the laws, what happened last time was in consulates in India, US consulates in India were so understaffed that you had to wait like 6 months for an interview to be considered for a visa. So if that happens, this is going to be a big blow for India's service exports. So there are constraints on India's exports. India has a young, low-skilled, very fast-growing labor force. So the key here is low-skilled and fast-growing. So the jobs cannot keep pace with the growth of the labor force, so it's a real problem. So the demographic dividend often becomes a demographic curse. And tariffs have kept growing. I mean, if you look at the tariffs from 10% in 2015 to 15% in 2021, the average MF1 tariffs. You look at simple average applied tariffs, grown from 8.9. This is Arvind Panagaria's calculations, 8.9 in 2010, 11 to 11.1 in 2020-21. the proportion of tariff lines that were above 15%, from 12% to 25%. So this kind of mercantilist policy is not really feasible. I mean, you cannot think of high growth, growth in exports if you are actually trying to protect imports. And this is basically, I've talked a lot about that, but learner symmetry comes from the fact that we have limited resources. You want to produce more of one kind of goods, you have to produce less of the other type, which is what you produce for exports. So it's basically, and India often works against its labor-intensive input processing industries. There's what we call tariff inversion, and that's being reversed a little bit in the last two budgets. That's good news. But that's tariff inversion basically means you're putting more tariffs on imports of inputs than the imports of output, which basically has negative effects on your exports. So these policies will need to be fixed. Of course, there are labor regulation problems. Land acquisition regulations are severe, right? There might be problems with land acquisition, but you are not even allowed to kind of have high-rise buildings where the acquisition you can get around the acquisition regulations because there is a cap, right? So and of course, skilling and education. People have degrees, but if you look at the reports, they constantly say that the firms are not able to find people with the requisite skills. So that's a longer-term thing that those things have to be fixed. And the good news is that there are FTAs that India is signing on to. The most recent being the one with Australia. Australia might be small in size, but its per capita income is quite big, so its overall economic size is not small at all. So there's a thing about PMP, the phase manufacturing program, which is, I think, very misguided. Which basically you want to have all the whole supply chain in India, rather than be a part of global supply chains, and that as has been shown in empirical studies, basically the total value added that you get from totally indigenizing supply chains by having tariffs on all kinds of inputs is it actually ends up hurting. So unless these problems are fixed, I don't have the same optimism as Tiago, but we are seeing some good signs now. So I will stop on a slightly optimistic note that there are some signs that these problems are getting fixed. I'll end there.
Thanks a lot for that wonderful discussion. I was getting some text messages from people in the crowd saying it's a great first session to start with this global outlook. If I were to give a tweet version of the three sessions, I think the one highlight from David's remarks was that the US economy is growing at about 2.5% now, which is roughly 3 times the forecast at the beginning of the year. So that's kind of, he laid out why things are better and while outlining some risks. From Tiago, I think what stood out to me was the Chinese economic growth model is exhausted, and we need to find, that's a hard-hitting message, and a different model for the growth for the world. And from Devashish, what stood out to me was that the golden age of trade is over by 2017, right? So 2007, yes. So let me start by asking a question first to David. David, you did not get a chance to talk so much about the fiscal risks in the US. Tiago talked about the sovereign debt risk, especially in EMs, emerging markets. But are you worried about a fiscal crisis or fiscal problem coming out of the US? So as from a perspective of India or other emerging markets, as we know from the 2007, 2008 crisis, the problem in the subprime, the financial markets in the US spilled over to the rest of the world. Could the next global crisis actually come from the US sovereign sector?
Okay, so first the bad news. We have a primary fiscal deficit, about 5% of GDP, wider than it has typically been when the economy has been at full employment. We have a debt to GDP ratio that is quickly converging on the post-World War II all-time high. I think the biggest thing, which is probably the biggest surprise to most people relative to 2019, is that we now have interest rates across the Treasury curve that are a lot higher than any policymakers were anticipating back in 2019 when they did these sorts of long-term debt projections. Basically, people bought into this kind of post-financial crisis. We're going to have extraordinarily low interest rates forever. And I think went way too far in concluding that we therefore don't have to worry about the public debt by 2019. So in a way, that's actually the most worrisome of the bunch, at least, or that's the biggest piece of new information. Is the current fiscal trajectory sustainable? No, it's rising quickly. Is there any political momentum to do anything about it anytime soon? No. The last time that we really engaged in systematic deficit reduction in the late 80s, early 1990s, one key thing that was different back then, if you remember Ross Perot's, by third-party standards, very successful campaign, is that the public was invested in this issue. And these days, somewhat oddly, considering that the debt to GDP ratio is about triple what it was back then, the public's not very invested in it, so there's not a big incentive for politicians to prioritize this. So in the near term, it's probably going to get worse rather than to get better. I think it's very hard to predict when financial markets will get worried about this sort of thing, when we'll get the kind of event that we saw in the UK with Liz Truss. So I won't try to predict when that will happen. It's a possibility. It's something to be alert to, but I think it's something of a lost cause to say when markets might panic about this and demand more of a fiscal risk premium for U.S. Treasuries. What I would say is, it's not an unsolvable problem. The point that has been made for many, many years about the US and similarly Japan is that the government collects a more modest share of revenue, of GDP and revenue, than many advanced economies do. So while there doesn't seem to be any political momentum in that direction now, increasing revenue collection is a possible answer there. The other thing I would say is, what you worry about in this sort of situation, and this is not a completely wacky thing to worry about in a US context, because this is actually what happened after World War II. You worry that the costs of financing the debt are so great that the political authorities put pressure on the central bank, and that the central bank no longer has a free hand to fight inflation, has to prioritize keeping interest rates low. I guess the reason I find it a little hard to get too worried about that is, for one, I don't think that's really part of the political conversation now. The other thing I would say, and I think this is the lesson of the last few business cycles, is that inflation expectations are well anchored in the United States. So running the economy a little hotter or a little cooler because you've left interest rates a little higher or a little bit lower, the consequences of that for inflation just, I find it hard to panic over that. So it's not where we are right now. I don't think it's where we're headed. I think there are easier solutions. But for the time being, I don't know that we're going to move in that direction.
It's going to get worse, but not to get worried now. Tiago, you talked about the growth model of China, and you were more optimistic than Devashish on the Indian growth model, maybe in the near term. What, in your view, can India do? Should they emulate the Chinese growth model, or do they need to look? Also, Brazil, India and Brazil, you also have expertise in Brazil. Can countries like India and Brazil come up with their own model, or they need to go where the Chinese model was for growth?
Yeah, I mean, first of all, I don't feel that I'm optimistic on India's prospects, to be very clear. My sense is that whether or not we are going to find a replacement to China is an open question. The point I tried to make was that if there is one country that can take the baton, that country is India. I have a hard time seeing other large emerging markets doing the job at this point. Now, that being said, can India emulate the Chinese model? I don't think so. And I don't think so for several reasons. First, because of, as I mentioned in my presentation, the buildup of excess capacity in China's manufacturing export sector is so large. For example, Chinese production of solar panels is twice the size, more than twice the size of the global demand. Okay? China has extreme levels of excess capacity in battery production and in many other segments within manufacturing. So, I mean, it will be very hard for any country to compete against China. It will take, to compete against China in manufacturing, it will take a long time for them to address these imbalances and to redirect capital and resources away from these sectors. And so it will be very hard for India or for any other country to compete in global manufacturing. So from that standpoint, it's not a model that can be emulated for the time being. The other thing is that, as we have seen, I mean, we are going through a period of trade wars and discussions about tariffs. So I would say, to summarize, like a period in which globalization is not being favored and perhaps deglobalization or reorganization is the topic of the jour. And so in that context, it becomes harder to think of a growth model that is predicated on exports of cheap manufacturing goods based on low labor costs, right? So that's a second factor. Third factor, the Chinese growth model is highly capital intensive. It requires a lot of like reallocation of resources over time and a lot of contribution from the public sector. It's much easier to be doing that in a sort of like centralized regime like China. It's much more difficult to sort of like marshal resources in the scale that you need to make that work quickly in a democracy, even a democracy that is sometimes subject to some frictions like India. So that's another limitation that I see. And even if somehow you can overcome these obstacles, you still have the issue of, will that growth model be able to generate the jobs that India needs in the years ahead to propel its economy? India needs to move over 100 million people from its agricultural sector to its manufacturing sector if it wants to emulate that kind of growth model. It's far from clear. The historical experience with employment in the manufacturing sector has been disappointing. And I would say that one of the areas in which technological revolution will have a significant impact in labor markets is through robotics, and that will have a significant impact in manufacturing activities as well. So when you put all these things together, my sense is that it's highly unlikely that India will succeed, not even accounting for its own shortcomings domestically, but just because of this confluence of factors, it's highly unlikely that India will succeed using the Chinese growth model to develop its economy. It will have to rely on services. It will have to rely on software design. It will have to rely on fintech and tech in general as a growth model, perhaps.
Actually, building on that, Devashish, it was really nice that at the end you talked about how India can potentially benefit from the new reality on trade. The one question, but then you gave us all the reasons why it cannot benefit, and I think most of us here would agree on the things that you mentioned, include phase manufacturing, the PMP program, or other extremely high tariffs on inputs, basically, relatively high tariffs. The one question I did have is, in a way, if you, as you showed us in the Trump plan, the U.S. has, in his plan, there's differential tariffs for China and then the rest of the world, and that differential basically goes up. So if you hold the conditions in India constant, all the constraints in India constant, that should still give you a push factor for a country like India to benefit. So are there any quick wins that India could benefit from to attract some of the companies that are leaving China, or the trade networks that are leaving China?
So one of the things that, with a 60% tariff and a 20% tariff, one of the things that might happen is that might lead to more production here in the US through robotization, because, with these labor-intensive manufacturers, using American labor is going to be very expensive. So there could be a lot more automation here as a result in the US. It could be a lot of robotization, and that's how they will produce. I mean, the jobs are not coming back to humans here, probably to robots. So that's one thing. But India still has a lot of things it can fix. Of course, this education and skilling thing is a more long-run thing. It cannot be fixed overnight. But the fact that, there is the possibility of online education, online training, and it really helps, transforming the labor force. We've also, Arvind Panagari has written a lot on that. I've also written a bit on that, on this issue of autonomous economic zones. I think that those are really needed in India. You have these special economic zones in India that are really small, like 20 square kilometers and so on. And then in China, they had like 2,000 square kilometers, Shenzhen, right? At least try to have something which is like, 300 to 500 square kilometers where your labor regulations are more relaxed. You can basically build those in areas where people are currently living, and that basically gives opportunities for agglomeration, firms, what we call, labor market pooling, in the sense that there'll be related production activity taking place in the same area that could provide a lot of what we call economies of scale. So that's the other thing India can do. But one of the things that it can easily do is probably get rid of PMP. That can be done pretty easily. I don't know whether politically it would be a good thing or not, but in terms of economics, I can, tell anyone that it would be a good economic move.
I think we all would agree with that. Maybe Ananta also has something to say. Okay, let's take 3 questions from the audience, and then we can just take the questions and then we answer. So we have Praveen, we have and these 2 folks in the front. Maybe one from a student as well, please. Yes, Tanush. Okay, so we take 4. Yeah, just. Yes.
Well, first of all, thank you to the panelists for an excellent session. My question is addressed to David, and in particular about the sort of debt to GDP statistics, which potentially might be reaching kind of a challenging point. My question was about the maturity structure of this debt, and I wondered if, given the fact that some of this debt was undertaken longer term in particular, might have been undertaken during years of very low interest rates, if looking at that maturity structure and interest payments instead changes the picture at all, or if it doesn't. That's my question.
Thanks so much. Congratulations on a great discussion. In the last Trump trade wars, in addition to the effects of the tariffs, the Fed did some very good estimations on the effects of trade policy uncertainty on capital markets, and so the effects on the capital markets were even greater than really the trade effect, the tariff effects. I wonder if you factor that into your thinking about the effects of, a next round of a real trade wars. And I guess another observation is that, Trump used that uncertainty to try to cut deals where he could, of course, with China, but elsewhere. So I'm wondering, is India part of a picture where you could imagine that sort of threat of uncertainty would translate into something different in relations between the U.S. and India?
Let's just take 2 more, and then.
Yes, so thank you. This is a question about India. Sorry? Yeah, I'm Rahul Saxena. I'm an alum of the economics department here, but that's a long time back. Thanks for the discussion. The question is about Indian growth. We're talking about export-led growth of China and seeing if that is an example or a model to follow. But I do share my concern about the Indian economy, but I'm pinning my hope on 2 things, and perhaps you can speak about this. The infrastructure has dramatically improved in India, which has been a factor holding back manufacturing. And the other is that the Indian economy has, unlike China's, been more led by domestic consumption and so on. So perhaps you can speak in terms of the perspective of the prospects for future growth on the basis of two things. One, impediment that has been removed or is being removed, which is infrastructure and policy. And the second being the domestically led growth.
30 seconds each, 30 seconds to a minute each just to answer whichever questions you would like from these. Maybe David can take the first.
So on the first, that's true. The average maturity of U.S. government debt's about 6 years, so the average rate is currently below the marginal rate. It's already begun to roll over at higher interest rates. If you look at projections for interest expense or real interest expense, as has become more popular as a share of GDP, those are rising very quickly and look much worse than, I'd say even our relatively pessimistic trajectory as of 2019. So the same message is there. On the other question, my own take would be about the capital market response, that it was wildly overblown, that you had moderate tariffs on exports from China that basically function like an excise tax, that led to some rerouting of trade, didn't have huge real consequences, that in the end they kind of lost their nerve when it came to imposing the final round of tariffs because they got blowback from big business and because they were probably worried, as I think the last couple of years have confirmed, that ordinary people get really mad when there's inflation and they blame the president for it. So it's politically a bit of a dangerous thing to do. The equity market response, I think, was just dramatically out of proportion to the actual economic consequences. And then there was this kind of weird effort to give that kind of an intellectual blessing by saying, well, in theory, trade policy uncertainty could have these big effects. The U.S. economy grew something like 3.3% in 2019, Q4 and Q4. So the idea that this was threatening recession and something that desperately required a monetary policy easing, I think, is not really true.
So there's work that shows that trade policy, the removal of trade policy uncertainty when China entered the WTO led to a big surge in imports from China. There's a big literature on that, big trade literature on that. So trade policy uncertainty does matter, but there's a recent literature that kind of tries to see how that uncertainty changed after Trump left the White House. And initially, so this is work by people at the University of Rochester, and then there's one of my colleagues at Syracuse. They've done some work. They showed that the expectation was that, and they actually calculated these probabilities based on the data, trade data they see. The expectation was that it would be kind of reversed, but then over time, the probabilities were like went higher and higher, that those high tariffs would stay as they were not coming down. But with Trump, yeah, India is not insulated from that uncertainty for sure. I mean, India could be the next target. Who knows which country would be his next target after China? So we really don't know. And the other thing about infrastructure, I agree with you. India has done in the last few years, and this government has done a terrific job with infrastructure, especially roads and fiber optic cables and those kinds of things. So what happens is, India had a number of constraints on its exports, but at any given time, only one constraint is binding. But the infrastructure constraint has been kind of relaxed, so then the other constraints become binding, right? So, for example, the high tariffs and so on. Yeah.
I'll touch on the issue that you mentioned on sort of like a more inward-looking type of like growth model, and it might be part of the solution. I think our appreciation for export-led growth is predicated on the history of countries that have done like miracles, like Korea or Japan or China, of course. And so there is some expectation that that's a viable model to develop an economy relatively quickly. The experience of countries like my home country of Brazil that adopted a very different growth model, which was basically inward-looking, policy-driven type of model, protection of domestic industries, and et cetera, et cetera. ended up being a failure in terms of development. It really like reached the boundaries of its ability to grow, generate imbalances and all of that. And for the last 40 years, Brazil has had a hard time to consistently grow at a rapid pace. And so I do think that whatever growth model India finds will probably have more reliance on the domestic economy than on the external sectors, as China did. I think that is correct. But I would just be careful not to overplay that hand and run the risk of like relying on protectionist policies and over activism on fiscal and monetary policies and regulatory policies domestically to try to engineer growth, because we have had many experiences that historically have failed using that kind of model as well.
So thanks a lot for those interventions. That brings us to a